On June 4th, 2026, I had 2 profit targets filled automatically in the first 10 minutes of the session. One of them was Marvell Technology, a bull put credit spread that returned $545 in 5 days. But the trade wasn't won on June 4th. It was won on May 28th, the day I entered. Every decision that made this trade profitable happened before a single dollar was at risk. This is the 6-step checklist I run on every position before I enter. I'm going to apply it to the Marvell trade in real time so you can see exactly how it works. Step 1. Bias. Before I look at strikes or expiry or premium, I need to answer one question. What do I think this stock is going to do? For Marvell Technology, the bias was clear. The company had just launched the Teralynx T100, a custom AI networking chip designed for hyperscale data centers. The AI infrastructure build-out was accelerating. Marvell was at the center of it. The bias was bullish. Bias isn't a prediction, it's a direction. I'm not saying the stock will go up. I'm saying the weight of evidence points up. And I want a position that profits if I'm right and has defined loss if I'm wrong. Step 2. Chart level. Marvell had just reported earnings. The stock gapped up, then pulled back to $205 as the initial move faded. That post-earnings low became the key level. This is critical. I entered after earnings, not before. Most retail traders try to position ahead of an earnings catalyst. That's a binary gamble. I waited for the earnings to happen, for the implied volatility crush to complete, for the stock to find its post-earnings low, and then I entered on a recovering name with confirmed support. $205 was the level. The stock had already shown it was willing to hold there. That's the foundation for the trade. Step 3. Strike selection. The 10% cushion rule. The short put strike must be at least 10% below the stock price at entry. No exceptions. At $205, 10% below is $184.50. I selected the $180 strike, giving me 12.2% cushion from the entry price. That means Marvell has to fall more than 12% before my short put is even tested. Combined with the post-earnings support at $205, the short strike was sitting well below a confirmed floor. That's 2 layers of protection, the cushion rule and the chart level working together. Step 4. Expiration. 50 days to expiry, July 17th. This is where I see a lot of new traders make mistakes. They sell puts with 7 or 10 days to expiry chasing high premium, and then one bad day wipes out weeks of gains. 50 days to expiry gives the trade room to breathe. The stock can move against me, consolidate, and recover, all before expiry. I held this position for only 5 days before the profit target filled. But having 50 days of runway meant I wasn't forced out by time decay pressure. The longer expiry gave me patience, and patience is the trade. Step 5. Maximum loss. Before I enter any position, I calculate the exact maximum loss and make sure I'm comfortable losing that amount entirely. On this trade, $10 spread width minus $3.367 credit received equals $6.633 maximum loss per share, times 100 shares per contract, $663 maximum risk per contract, times 3 contracts, approximately $1,990 total maximum risk. $1,990 on a $50,000 account, 3.98% of capital. If this trade goes to zero, I lose less than 4% of the account and I move on. Defined risk is what separates option spreads from naked options. I know my maximum loss before I enter. There are no surprises. Step 6. Profit target. 50% of the credit received. That's the first exit rule. Always. I collected $3.367 in credit. 50% of that is $1.683. So I placed a good till canceled order to buy back the spread at $1.55. On this trade, I was holding 3 contracts. The 50% rule applies to the first take profit. Close the position when the spread reaches 50% of max profit, lock in the gain, and let remaining contracts ride if the thesis is still intact. When Marvell gapped up 16% on the Teralynx T100 launch, both puts went deep out of the money. The good till canceled order filled automatically at $1.55 on June 2nd. The move was so strong and so fast that closing the full position at the first target was the right call. $545.10. 5 days, automated exit. The checklist worked. The lesson. The best bull put credit spreads share 3 things: a clear directional bias, a strike price well below confirmed support, and an entry after the binary event, not before. Most retail traders try to predict earnings. I wait for them. The implied volatility crush is done. The low is confirmed. The recovery is underway. That's when the risk-reward on selling puts is most favorable. 6 steps, every trade, no exceptions. Every position I take, entries, exits, wins, and losses, gets documented in my free weekly newsletter. Link in the description. Subscribe free. If you enjoyed this video, please like and subscribe to help grow this channel. And thanks for watching.